Good morning. No, start over. Good, oh, Jesus. Good morning, you bunch of beautiful freaking people. What is up, everybody? Welcome to Trey's Trades, where we freaking talk fast and slap the ass, baby. I'd like to preface by saying that I'm not a financial advisor nor expert, so take what I say with a grain of salt. Let's get into the video. So today, my friends, my family, my fellow Gorilla Gang, we're gonna be starting off the morning talking about a loan recall, right? So I'm actually gonna be reading this from a little bit of Reddit, right? And I've got this preface and sort of mapped out here on Microsoft Whiteboard. But I wanted to give credit where credit is due. This is a guy that is in my personal Discord. His name is Late Chuck. Late Chuck threw together some freaking really solid due diligence and research that is backed by some actual documentation, which is solid. So I'm gonna leave a link to this in the description box down below if you want to check it out. But this is some super intelligent, smooth-brained ape stuff, and we got to talk about it. So without further ado, let's just get straight into the freaking video. So what we're going to be talking about today is AMC, the recall. And now what do I mean by this? A lot of people seem to talk about essentially this idea of margin calls, right? And margin calls are super important to AMC stock. You can think about it like this. I freaking didn't realize my mic was off in this first recording, so I got to start over essentially. But think about this, right? You've got a hedge fund out here. We're just going to call them Citadel Capital, right? Citadel has 100 shares long in a stock, and they also have 500 shares short in a stock, right? Now, what happens if they're 500 shares short, make them net profit negative on, any given day? They can get margin called. And typically what that looks like is, not all the time, but most of the time, they give you X amount of time to meet the collateral requirements in your account so they don't liquidate you. And if you can't, they liquidate you, right? They cover, they sell your long positions and they cover your long positions. And boom, your margin called. You really get screwed. Long position stocks usually go down, and short position stocks usually make the stock go up when you cover, right? But something that isn't really talked about is this idea of a forcible recall. Now, what do I mean by this? This is directly associated with the Ortex data, the stuff that we talk about every single day. Now, as it sits right now, the Ortex data is sitting at 99.32%, but there was a short period of time when you saw it drop down to 96% here, right? From 100% for weeks and weeks and weeks, drop down to 96%. And we didn't see any sort of, price action during that period of time when you saw some of those shares on loan get recalled or brought back or returned or whatever the actual truth is. And because truth is, this is a hypothesis. This is, we can't prove it in the least bit, but this is very interesting data and information nonetheless to share. But nonetheless, right, we saw that this happened. So I wanted to give you guys maybe some correlation, not causation, that we have here in terms of research and how this could be tied together, right? So essentially this paper, this is coming from a very intelligent guy. His name is Paul Schultz. He's actually a professor of finance at Notre Dame. And he put together a really solid, top-notch academic piece of research. And it's essentially talking about the risks of short selling, how this is associated with loan recalls and utilization, right? And we're going to dig into all this sort of stuff that you're not lost in the sauce and you understand everything that we're exactly talking about. So essentially, Professor Schultz, Paul Schultz, says short selling is risky. He provides the data of why. We all know that short selling is risky. It's because obviously, a stock has infinite upside for loss when you go short on it, but only a limited amount of downside for gains, right? So that's a huge piece of why short selling is risky. But the more important and more interesting piece is this idea of a forcible loan recall. And it directly ties into this utilization rate. And we're actually going to show you the similarities and how this ties into the Ortex data, right? Now, why is this important? So let's just talk about short selling. Short selling risks are tied to utilization. Utilization is the idea of how many, percentage-wise, how many shares that are available for lending are out on loan. 100% of utilization means that all shares available for lending are out on loan. 0% means that none of them are out on loan, right? So it just gives you an idea of how easily available it is to borrow or loan a stock from a lender, right? So short selling risks are tied to utilization of the proportion of shares available to lend that are actually on loan. It's a proxy for the risk that a loan may recall force a short seller to close a position. I use an equal reduction in shares available to lend and shares on loan on the same day. For most stocks, this is a rare event. A rare event essentially saying that, hey, most of the time you're going to get forcible recall of stock, right? And it's going to get very freaking interesting. I'm going to tell you guys something here in a little sec. So for easily borrowed stocks, and you can think of this as anything that has less than a 75% utilization rate. This is currently sitting at 99.32 and has for a very long time. So keep that in the back of your mind when you're looking at this, right? So for anything under 75%, you usually only have a loan recall once about every 8 years. It is not very frequently that you see a forcible loan recall. So you can think about it like this, right? If a stock is easy to borrow, easy to be lent, typically the chances of you being forcibly recalled, whatever shares that you have out on loan, right, is low. And you can think about it very simply. It's how many shares are available for lending so that you can continue to have transactions and customers and clients that come in and borrow stock, right? And what are the risks associated with having those shares out on loan? If there's a high risk and there's not a lot of shares available to borrow, you've got a very high shot at getting your shares recalled. And it's going to get more interesting. I swear to God, you guys are going to be blown away. It's stupid, but this is stupid, right? For stocks with utilization above 75%, forced recalls occur about once every 26 days. So utilization is strongly associated with recall risk. Holy Toledo. Once every 26 days for something over 75%. Well, check this out, guys. Very fascinating because we've been at 100% or dang near close for literally a month. Check this out. 99.4% utilization as of April 16th. It is currently May 25th. The lowest we have been in the last month is 96% utilization. Now, what happened right here, right? What happened right here when we dropped down to about 96% utilization? Could it have been a forcible recall? And this is something that we really definitely need to talk about in terms of what is going on here with these loan recalls is they don't have to give you any sort of warning. And that's the most interesting piece of this to me easily. Now, what do I mean by that, right? Think about it like this. Let's just say that Jimmy over here, Jimmy wants to go long on 100 stocks, right? He wants to go long on 100 shares of AMC. Bam, he buys 100 shares. Well, what would happen if somewhere in the fine print of his brokerage, the brokerage said, hey, Jimmy, you can go long on 100 shares of AMC, but at any time, if we decide that we don't have enough shares available, for buying or the risk of you going long on a stock is too high, we're going to basically close you out. We want those shares back, right? What would happen? You think Jimmy would want to buy that stock? You think Jimmy would want to do it? Probably freaking not, especially if he knew that there was a high chance that there's not a lot of stock available and a high chance that he's not going to be profitable on it. He probably wouldn't want to do that, right? Well, essentially, you have the exact opposite thing happening right now for Hedgie. Hedgie over here, it wants to go short instead of 100 shares, freaking 100 million. That's what the shares on loan has been as high as before. He wants to go short 100 million shares on AMC. And somewhere in the fine print, when he's borrowing the stock and the contracts they write, whatever they freaking sign, they say, hey, look, Hedgie, you can go short 100 million shares. You can borrow 100 million shares if you want. But just know this, right? Just know, if we don't have enough shares available for lending, we can recall your shares any freaking time that we want. And if the risk associated with you having a short position or having those shares on a loan is too high, the cost to borrow is too high, we can recall these at any given time that we want. Would you want to borrow that stock? Probably freaking not. Makes no sense. And guess what, guys? Guess what? They still do it. They still do it because the utilization has been maxed out at 100% for who knows how goddamn long. I mean, this is the longest it has been this high that I have seen. I mean, look at this trend. Look at this trend line up here, right? Highest has been at 100%. The longest has been that high is way back here. It has not been that high. I mean, this is the longest time you've seen this many shares out on loan since AMC has basically traded over the last year. It is absolutely absurd, right? So this idea that they can essentially recall your shares with no warnings in the least bit comes from IKBR or Interactive Brokers, right? So essentially, they don't have to give you any sort of warning. And this is actually coming from the professor of finance from Notre Dame, Paul Schultz, as well, right? He puts this in his research paper. Without having a reason, the lender has the right to request the return of the shares at any time. Now, shares are not numbered, and the broker can give the lender back any AMC shares. But if the event occurs that there are no shares to borrow left, the broker has a problem. He has to find new ones. If he cannot lend it from elsewhere, the fund begins. Essentially, the loan recalls, the forcible recalls of stock. And I would not be surprised in the least bit. Obviously, this is a hypothesis, it's speculation, but I wouldn't be surprised if you see this start happening very, very, very soon. It's a prediction. I've got a prediction for you, right? Sometime in the next couple of weeks or month, I think you're going to start seeing some forcible recalls. The higher that AMC stock continues to rise, guys, the longer and longer and longer that AMC is bullish. I mean, just look at the last 3 months, guys. The risk is ramping up. This is getting really, really risky for anybody who wants to be lent stock. Whoever wants to short stock, whoever wants shares on loan in this AMC stock. It is absurd. It makes absolutely no sense. So the longer this game plays out, guys, I think you're going to see this utilization get forcibly recalled back simply based on the numbers, right? One every 26 days? That's for 75% or higher, right? What? That's absurd. I mean, this is groundbreaking stuff. I literally haven't heard anybody talk about this. I mean, this could really be a game changer in terms of getting shorts to be freaking underneath the fire hose. I mean, this is pressure. This is pressure to a T. You were turning a big freaking diamond into a turd. I mean, you're somehow reverse splitting atoms and turning these freaking diamond-handed, who knows what, hedge funds into putty. I mean, this is essentially what it is, hey, we do not have to give you any freaking warnings, and we can end your freaking dreams and goals and financial strength. There's one last thing I want to talk about, right? And it's T+2, right? So this is the last big piece of the DD that I kind of want to dig into. And this is the idea of when stock is actually bought back, right? So T stands for transaction date, +2 indicates the time. In our case, 2 days. How long after the transaction date the settlement takes place, right? So think about it like this. Return shares happens instantaneously. So if a lender decides, hey, we want to recall your stock, they get that stock back, right? But the settlement, right, takes time plus 2 days. Now, what does this mean? If you were to look at the grand scheme of things, let's just look at AMC stock, like, I don't know, right here. For instance, let's say that there was some share recalls somewhere in this moment in time. 1 day, 2 days, you could have seen that the actual, transactions and the buying pressure took place 2 days later, right? Because that's where the T+2 comes into place. True, they instantaneously get their shares returned, they instantaneously get them back, but the settlement time is T+2. So it might actually take some time for the actual buying pressure of these stocks that are being recalled to play into the equation to be bought back, essentially, right? So that's a pretty fascinating piece of the equation as well, in terms of T+2 and how that can actually serve the overall game plan, right? Only days are counted on which the stock market is open. So the borrower has a trading day he closes is forced to close his position plus additional 2 days to fulfill his obligation. So they get between then and 2 days later in order to get everything squared away, right? Remember the Ortex tweet. The shares returned today have not been bought today. May 14th. Very freaking fascinating stuff, guys. And to kind of sum this up, like Late Chuck said, this is a domino effect of loan recalls that could have started. I believe it. I'm going to put myself out there. I'm going to say it. I think the utilization sometime over the next couple of weeks to month is going to drop significantly. I think you're going to see forcible recall on stock, forcible recall on loan, right? That is going to start drastically dragging down short positions and forcing them to return lent stock, return short positions. That'll stack on top of these margin calls that are on the horizon, guys. And that's what I've got for this freaking video. So, blah, blah, blah. I know the whole spiel. Drop a like, consider subscribing, whatever you want to freaking do. Catch you all in the lunch break live stream later today if you want to tune in. Much love to my friends, my family, my fellow Gorilla Gang. Catch you later, and peace.